right now.
Exactly, exactly, exactly. So that's why it's just a family conversation amongst friends. So
Now you're while we're chatting, you're in Maryland, right?
I am, and it's
And but you do work everywhere in the nation.
yeah, no, we're a national appraisal company right outside the DC area. So
All right.
yeah, we're all over the country. So.
And how's business for you?
It is. It's interesting. It's interesting. The reason is a lot of it is, we're going through all the changes that everyone else is going through with rates going up and a decrease in business. But we're about 70% purchase, so it hasn't affected us as much as some of other people. Some of our clients are really hurting. We have some clients that are down, 60%. But some of them are doing fine. Like some of them just, haven't skipped a beat. And it really is it just depends. It just depends. But we're seeing it all. We're seeing it all. So, what about you?
And are you seeing any differences based on geography? Like are some areas of the nation down more than others, say, or not really?
No, I don't think that's really. I mean, I don't think that's. I mean, I don't think that's. I don't see that. I mean, value-wise, yeah, but um, not when it comes to activity, as far as this area. I mean, the places, like I always say, the places that do well kind of always do well. The places that do bad kind of always do bad. So it's one of these things where, look at a metro area like a DC or something like that. It does fairly well pretty much all the time. But you look at areas like, say Vegas, it's very sporadic with a whole lot of highs and a lot of lows, and that's pretty consistent that it goes through these kind of boom and busts periods. If you look historically, that it's gone through a lot of those ups and downs. So it's kind of, you can predict relatively easily what's going on. So what about you? What are you hearing?
What's going on out there? Is that the question?
Yeah.
Yeah, I would say that there are a lot of hopeful people out there. In 2012, 2011, 2012, 2013, at least the first half, was a good time to be a residential lender. We saw price appreciation in many markets, especially the markets that had really gone down a lot. They bounced back. For example, the Sand States. On top of that, we had low rates thanks to the government, and the underwriting guidelines started to loosen up a tad. So you had a nice confluence of events going on out there during that time period. So a lot of lenders were able to make hay while the sun shines, for example, especially in 2012 and the first half of 2013. We had, LO comp, which was a big question mark a couple of years ago, a couple of Aprils ago, which turned out almost to be a non-event in terms of putting a dent in the business. And so you had a lot of pent-up refis coming in, and certainly to make up for the lack of purchases. And then purchases started to swing in the second half of 2012, then first half of 2013. And so a lot of companies and a lot of originators did very, very well during that time period. So now everyone's saying, well, that was then, this is now. What are we going to do? Over the next 6-9 months. In many parts of the nation, as you know, the purchase market tends to sag during the last quarter of a year and the first quarter of the following year. Obviously, you have that going on, and then you have the refi market, for the most part, taking a break from the torrid pace. And everybody knew refis were going to tail off at some point. They might not have known how quickly it would happen, but nonetheless, the refi business is down, and the general feeling out there is that refis, the drop in refis has not been made up by purchases. Interestingly enough, many places in the country are seeing a lack of inventory. Realtors are also kind of crying the blues a little bit because there's just not a lot of inventory out there to sell. So
yeah, and that's something we're seeing as well. I mean, that we're seeing a lot of appraisers are trying to justify an increase in price. And that's something we'll get into, when we get into kind of more of the Q&A and kind of what we're seeing. But we've got about 200 people, 220 registered, in now, and that's enough to get started. And the increase number of people have stopped. So we're going to go ahead and get started. Again, this is Brian Coester and Rob Chrisman. This is part of Coester DMS webinar series on Conversation with Chrisman. So let's go ahead. So just to kind of give you guys a little bit about Rob, those that don't, as to a certain extent, is among friends, among family. He was telling me earlier that, he's had people stopping him at the airport, tell him, talking about his webinar that he's doing. So this is amongst friends. So we got a celebrity.
No, those were the Hare Krishna. I think you got the stories.
Yeah, exactly. We got a celebrity here. So he left his daily working world in late 2008 to focus on his family. We continue to publish a widely read daily market commentary, which many of you read. He spends 45 days an hour on this and wakes up at 4 a.m. to check the overnight news and edit the commentary before sending it out around 5:30 or 6 a.m. Pacific time. He's on the board of directors and advises boards of several financial companies, an associate of the Strathmore, a member of the California Mortgage Bankers Association, a member of the Mortgage Bankers Association of the Carolinas. Rob holds an MBS from Cal Poly, St. Louis Obispo, and MBA from UC Berkeley, and lives in California, where he can be found taking his 90-year-old father to Costco for hot dogs. If you're not a subscriber,
which is not elder abuse, by the way. Sometimes people say, "How can you do that?"
Yeah,
he likes those darn hot dogs.
How can you do that? Yeah, take my father to McDonald's. It's like, it's kind of abuse. But he likes them. He likes them. So. What we're going to do is the format for this is for some reason there was something that went out that this is 90 minutes. This is actually only 60 minutes. But we took in every single question has been taken in by some of the ones that are participants. So there's nothing that, nothing really that Rob came up with on his own for the most part, which, if you've known Rob, is not unlike Rob. But at the same time, what we want to do is get some participation. So we're going to try to do 30 minutes of questions. So even though some of these questions are 30 minutes of pre-taken in questions, so even though most of these questions you could spend a day on, he's not going to have time to do that. What he's going to try to do is about 10 minutes per question, and then we're going to, or a few sentences per question, and then we're going to open it up about 20 minutes of Q&A. I'm already getting questions. If you have questions, go ahead and submit them through the little mechanism in your GoToMeeting. So go ahead, let's get started. So Rob, kind of give you an overview of the market. I know you talked about it recently, and I know you talked about it, kind of before when we were waiting for people to come in. But what's going on? What can a mortgage banker expect in 2014, and what do you think is going to happen?
Well, as we were just talking about, the industry as a whole is coming off a couple of great years of earnings, a couple of great years of margins, and people, deep inside, they knew that this wasn't going to last forever. Eventually the refis would die down, eventually rates would go up, eventually things would change. Certainly the CFPB's influence is being felt on the industry. So what's going on is you have a lot of companies out there and a lot of originators saying, all right, we've had these good years. What's going to happen in the next 3, 6, 9 months? And as I said, nobody expects or expected the great times to go on forever. The question is, how are they going to continue to do well? We've only got a couple months left of this year, but then into the first half of next year, and it's going to be a difficult environment. I'm not going to sugarcoat anything. Obviously the margins have come down, and the margins have come down both at the company level and at the loan originator or branch level. It's not the companies who are taking all the pain. The typical thing is to blame the capital markets guy about, geez, how come you're pricing so much profit into these loans? Can't you give me an 8? Can't you give me a quarter kind of thing? So not only am I seeing companies give up margin, but also loan originators being asked to contribute, and also branch managers and branches and regions being asked to chip in to try to reduce margins. Unfortunately, of course, we're seeing reduced margins in a reduced volume environment. So it's kind of a double whammy there that everyone is dealing with, and it's not confined to small companies. Everybody's dealing with the same thing.
So let me say this: if everyone's dealing with it, how do you see people adjusting? How do you see, margins you can squeeze from both sides? What do you see people doing about it?
Well, they are. That's a good question. For lack of a clever, witty answer, I'd say they're dealing with it.
Okay.
It's kind of like, all right, well, gee, you're an old football player. How do you deal with being an old football player? Well, you just get up and do it again the next day, kind of thing. I mean, a lot of the originators that are out there, a lot of companies, they've been through a couple business cycles, so they've seen things like this happen before. And originators have really gone back to focusing on what they do best, which is getting business in the door, trying to get business in the door, working on marketing plans, working on their referral network, doing business kind of the old-fashioned way, sending out thank you notes, or returning phone calls and doing things like that. Companies everywhere are trying to become more efficient. They have scaled back their overhead. They've laid people off. They've tried to make IT and other procedures more efficient, try to save money that way. So try to cut overhead while the margins and while the volumes are decreasing. So you've got originators who are kind of retooling here. You've got companies trying to do the same thing in terms of efficiency and lower overhead. And then as an industry, everyone is trying to, and this is the reason for the call, obviously, but everyone's trying to keep up on the changing compliance and regulatory environment that everyone is facing. It's not, gee, it's only the big banks, only the small banks, only the independent mortgage banks. It's everybody. Everybody's being impacted by the changes in compliance and changes in regulatory environment. Very, very difficult out there. So what a mortgage banker can expect in 2014, kind of, if I had a crystal ball, it would be, I'd say it might be a little bit better than it is now, because hopefully in 2014 the CFPB and so forth, mainly the CFPB, which we'll get to in a bit here, but the CFPB will hopefully remove some of the uncertainty that's out there, because I continue to hear people say, just give us the rules, just tell us what tell us what a bona fide discount point is. Tell us tell us how to handle mortgage insurance. Tell us how, what is included in the 3%, things like that. I continue to hear, just tell us what it is so we can deal with it, so we can build our internal systems to accommodate that. And so the industry is searching for clarity that's not necessarily forthcoming from the regulators. And so, the rates might be kind of close to where they are now. The regulatory environment might be pretty similar to where it is now, which we'll get to in a bit here. But I think the industry will see more clarity as we go forward, and whether or not the clarity comes from the CFPB or the FHFA or even the large aggregators getting together and saying, all right, well, we're not hearing what we need to hear, let's just set our own standards. I think the industry is searching for that. So 2014, I think, will be a little bit better when it comes to that. And I kind of lapsed into what I think is going to happen next year, but that's
that's really good. And the thing is, and I'm in complete agreement with you on a lot of stuff. I was at a mortgage bankers conference, and somebody said at one point, in 2000, in early 2012, I couldn't hire people fast enough, and then in late 2013, I couldn't fire them fast enough. So, there's seen a lot of layoffs, and through I know a lot of our clients, we've seen a lot of branches get shut down, and people dealing with the legislation. But also, on the tech side, I'm very much a techie. You're seeing a lot of tech companies try to step up and plug those holes when it comes to compliance and when it comes to automating certain business processes and automating certain functions. And it's just that's something to be said across the industry. not just on the appraisal side, but just kind of across the industry of trying to fix things. So let's go ahead and get into the questions.
Well, I'm not. Hold on. Let me just say one more thing, and we'll kind of end on an optimistic note here. I think that many people in the industry got into the industry to help people. You know, whether it's to help them buy a house or help them lower their monthly payments. That feeling is still out there, and the feeling among the borrowers, among the buyers out there. You know, in spite of whatever is going on with the economy, Americans, they still want to be homeowners. And this industry is meant to help them, and yes, we can talk about all cash buyers and so forth, but the whole home ownership thing hasn't changed. And unfortunately, our heads have been turned here somewhat to deal with some of the compliance and regulatory issues, some of the unintended consequences of what's going on in Washington, D.C. But when you come right down to it, I think people in the industry do want to help others, and so it's good to know that Americans still want to own homes, and we're here to help them. So just trying to figure out how best to do that.
Yeah, exactly, and not only how best to do it, how to do it and still make a little money, which has become difficult in the regulatory environment. So getting right into the question. Go ahead.
I was going to say no one's here to run a nonprofit.
Yeah, exactly.
Company.
All right, so by far. The biggest, you know, we received a ton of questions, and some of these things we could not address them all, but by far the biggest ones were around QM. And so the first question, and we didn't put who it came from, but if this is your question, congratulations, is there's a lot of confusion with regard to the inclusion of MI premium in the 3% max points and fees for QM. As you noted in your blog a few weeks ago, the upfront MI premium is not included up to 1.75%. as long as it's refunded on a pro rata basis. Without a definition of pro rata, do you know the common definition as defined by Webster Dictionary? If so, most single premium MI payments would not be excluded from your 3% cap as they do not fit the definition of pro rata. Have you heard anything on this issue? Seems they're interchangeable based on the verbal information and can mislead a buyer, seller, real estate agent into thinking the lender has approved a loan only to find out it is based on the credit report and DU, not verification of assets, income, or down payment is done. Is the MI, if this MI is not excluded, do you think it will become extinct?
Well, so that's quite a lengthy question. So let's kind of get into it here a little bit. And it's fortunate because the CFPB had has provided some information on this. They and the MBA had held a joint webinar a couple weeks ago, and they addressed some of this. The points and fees calculation will create a potential issue for lenders, offering certain MI premium plans. But to keep things in perspective on the impact of this, the vast majority of MI policies, as best I can tell, issued are borrower-paid monthly premiums, which are exempt. And then if you ask the MI companies, the next most common usually are lender-paid single premiums, which are also exempt. And then the rest are things like borrower-paid single premiums, like this question is, or splits or financed MI. So when you look at the overall number of policies that are being issued, this is kind of a small subset of the total. But I'm sure the mortgage insurance companies are focused on offering solutions for these policy types. Once they have a clear definition from the CFPB, once again, they're waiting for guidance on the CFPB. The CFPB has not clearly defined what pro rata means. So almost any talk of a single premium being QM compliant or going extinct or whatever is somewhat problematic. There's a lot of anxiety over a small percentage of the overall MI business. So that's the good news. The bad news is, as I said, the industry is waiting for input, for guidance from the CFPB on what exactly they mean by pro rata and so forth. So we're waiting for more interpretation on that. But if you look at the overall scheme of things, the borrower-paid single is a relatively small portion of the business. So do I think it will become extinct? Not necessarily, but even if the market were to lose, 3% or 5% of that, I think that borrowers and companies are pretty resourceful, as are the MI companies, so they might create a workaround.
Got it. Got it. Is there anything left? Because so that question is just that's the most complicated thing I've ever heard. And being on the appraisal side, we do a lot of complicated things. Is that all to that, or is there anything more?
Yeah, that's pretty much it.
That's pretty much it. Yeah.
Like I said, the mortgage insurance companies are waiting for some kind of guidance from the CFPB on some of these issues. But I think that once again, if you look at the overall business, it's not too big of a part of what MI companies are doing right now.
Got it. All right, and to everyone, I'm getting a lot of questions about this. Is being recorded, so this is being recorded, so we'll in the screens the slides will be available later on. So you take good notes, but you don't have to remember everything he said. Getting on our next question is that I'm sure you heard that Wells Fargo is telling its clients that it will not exclude any discount points from the 3% max and fees under QM. Have you heard this, and are other lenders taking this position? Also, what other overlays have you come across?
So I have heard that, although nothing definitive. I've kind of heard rumblings like that. I'm sure that, for example, though, if Wells Fargo Correspondent does that, their Wells Retail Group will follow suit. But I've also heard that Chase is taking a little bit of a divergent path, and it comes down to what is the definition of bona fide discount points. And once again, both companies and the entire industry are waiting for some guidance from the CFPB in terms of in terms of some of these specifics. I've also heard rumblings that unless the CFPB steps up and does this or addresses some of these questions, that the aggregators will, collusion is way too strong a word, but in the face of necessity of needing some guidance here heading into the first part of next year, you may have Wells and Citi and Chase and Bank of America, U.S. Bank, some of the other big aggregators come together and say, okay, well, this is the standard that we've set given what we know from the CFPB, and move forward. But in answer to this question, I haven't heard anything definitive, but I have heard the same thing with regard to the 3%. Got
it. All right. Let me ask you this. What do you think about, and this just goes into the reverse mortgage space, what do you think about the traditional mortgage originators diversifying and beginning to include HECMs in their product offering and marketing? Are you seeing that?
I'm seeing a little of that. I'm seeing traditional reverse mortgage lenders, and especially loan officers who specialize in reverse mortgages, continuing to use their experience and use their knowledge to their advantage. I think that if somebody says, oh my gosh, I can't make enough money doing Fannie Mae and Freddie Mac or FHA, VA loans, I think I'll start doing reverse mortgages. They really need to do a lot of research into the program, because they aren't slam dunk deals, as any reverse mortgage lender will tell you. Counseling is involved, licensing and so forth, a lot of training, a lot of borrower hand-holding. You certainly don't want the Gray Panthers picketing outside your office because you mess up any kind of off product like a reverse mortgage or a HECM or anything like that. So with regard to the HECM specifically, not only does it require, it's just not a slam dunk deal, but you also have a lot of banks who are very, very interested in this product. And whether or not the banks want to offer that on a wholesale or a correspondent basis remains to be seen. They're very happy giving the home equity product to their own originators in their own branches and satisfying the need there. But given the complexity of getting a first mortgage right now, or possible complexity looking ahead to next year, I think many institutions are looking at HECM as a growth area, and a lot of originators are looking at it as a growth area as well. So, yeah, I think we have seen that, and we're going to see more lenders become interested in the home equity products.
Got it. Got it. All right. Well, good. All good stuff. All right. So finally, a question. Out of all the questions that came in, there was only maybe hundreds of questions. So there's probably only 3 or 4 that I would be able to that would be kind of something in my neck of the woods or my wheelhouse. So the question is that if we have an appraisal validation process in place to validate the value of an appraisal, I understand that with the implementation of UAD and UCDP, a reduced value from an AVM and desk review cannot be used by the lender as the appraised value, but can the value from a field review report be used as a value assigned to the property? And so the short answer to that is the appraisal is the appraisal. When it comes to UAD and UCDP, I think what Fannie and Freddie are really trying to do is dial in, and I think everyone knows this, is dial in on the quality of the data and the quality of the reporting. And what they're finding is number one, that there's a lot of mistakes being made, and number two is also what they're finding is there's a lot of value in that data that they have to cross-reference other appraisals. Great example would be appraiser number 1 does an appraisal on a property and rates it as C1. Then he does another appraisal on a property and rates the same property that he used in the original report as a C2, and then makes an adjustment, and they're able to catch that and go back to the appraiser and do that. So there's a lot of validations. But when it comes to the field review report, you can't use that as the appraised value. Now you can use that as a tool to offset. You can use that as a tool for quality control, but as far as the appraised value, you cannot do it. What most of the time happens is, as an appraiser, and I'm actually a licensed appraiser, certified appraiser, what the underwriter would want is, or the DE would want, is those items on the field review addressed. They cannot assign it to that specific property, but they can make that a condition that the field review remedies or the field review problems found in the appraisal get noted before any type of closing or something like that. What we try to do and what we found is, there's no opinion that's 100% right when it comes to the appraisal process or who's right and who's wrong. But what we found is that a lot of times when it comes to different opinions on the report or errors in the report, sometimes it's just the underwriter's not comfortable, and then there's a unique property, and there's a reason that the field review was ordered that does justify, and then they can order a second subsequent report. But there's no changing of the original appraisal based on a field review, ABM, desk review, or anything else based on that. Now, that's separate and apart from kind of a lender's internal quality control, but the field review itself cannot be used to do that. The next question, error policy requires the lender to send a copy of the appraisal report to the borrower. Can the lender assign this responsibility to the AMC as long as the file documents was the appraisal delivered? And so the quick answer is yes. And so we don't care, and I always say this about certain policies when it comes to appraisal independence or Fannie Mae and FHA requirements and stuff like that. They don't care how you get to the end zone as long as you get there. And that's not 100% true in every situation, but when it comes to specifics like appraisal independence requirements or quality control procedures, they say they want this to happen. So how you figure that out is in your wheelhouse. Now, we do have a process in place that we send an email and there's a confirmation that the lender can get that's stored in the file, or they can get CC'd, or there's a variety of technological solutions. Most of those delivery of the appraisal report does get assigned to the AMC, or it becomes a responsibility of the AMC. There's definitely a business process issue associated with that when it comes to not having the borrower's email address, and if we've got to drop ship it, or if we've got to mail them out, it becomes expensive to do that. But generally speaking, it can be assigned to anybody. And what's going to happen is, at the end of the day, it's the lender's responsibility to make sure the borrower got a copy of that appraisal. How the lender makes that happen, whether through a third party or whether they do it themselves, is their business decision. But it's still the lender's, at the end of the day, it's the lender's responsibility. An AMC should be well equipped to handle that. I mean, it's not that complicated to handle logistics associated with it. And there's some technology stuff that can make that very easy when it comes to, especially with email, of getting confirmations and certain kind of signatures so that you can get via email verification processes and stuff that you can capture. But it's still up to me, the lender's responsibility. So, oh, good that there was only a couple questions that came with me. So next, Rob, you're back on. So I've seen a lot of talk lately of impending major stock market drop and the economy following another recession and flight for safety in the major stock investors. The support of the theory that that there's an aftermath of Bernanke's QE efforts and the devaluation of U.S. dollar. Do you think this news is valid, or is this more of a sky is falling mentality by this news organization? If there's no potential flight,
Well, can we put everybody on hold, Brian, while I go sell all my stocks? Now I'm nervous. I would say that my opinion on this isn't any more valid or less valid than anyone else's on the phone. I do think it is a sky is falling mentality. I think that a lot of people go on record as saying some doom and gloom things, and then they don't come to fruition, and then people forget about their, some forecast that was made a year or two ago, especially when it doesn't happen. The most famous one was Meredith Whitney a year or two or three ago saying the entire municipal bond market was going to crash, and it didn't. And so people tend to forget that forecasts are made, and when forecasts like this turn out to be right, then we're all reminded of it by the people who made the forecast. I don't see anything like this happening. There are a lot of really smart people out there who are taking bets every day on both sides of the stock market. The fact of the matter is, I think the U.S. economy is moving along. It's not going gangbusters. GDP and employment numbers surprised everybody recently toward the upside. I don't think anybody on the phone really wants a economy that's overheating, because then we're talking about rates going way up. I think people are pretty comfortable with the way the economy is going. I should say pretty comfortable. They're not entirely comfortable. Sure, there are some dark spots out there, but I don't see any reason why the stock market would totally go in the tank. If that were to happen, that must mean the economy is doing terribly, in which case money would flow into the bond market and drive bond prices up, and rates would go down, which would actually help our industry. But I just don't see signs that our economy is struggling as much as this question would suggest. So I do think that it is a little bit of the sky is falling mentality, and the flight to quality. We would already kind of be seeing that, but if you look around the world, Asia's doing okay, Europe's doing okay. We don't hear much about Europe at all anymore, and the U.S. is doing okay. So I don't see any big signs of trouble out there that would warrant a total adjustment in your portfolio.
So you're saying that we shouldn't just stock up on silver bullion and gold bullion and store them in the basement?
No. No, I mean, I'm not. I'm sure there are people out there doing that, but I'm not.
Exactly. I know some people that do that too. That's fine. All right, next question. With the new QM rules coming into effect in January, I've noticed some banks have decided that will offer non-QM product to help lending loans that may cause some well-qualified borrowers not to be eligible for a QM product. Do you see this becoming an emerging pattern? Do you foresee major investors, i.e. Chase, Wells Fargo, offering a non-QM product? If so, do you think these products would be something a correspondent lender can hedge against, or would they tend to lean towards a best efforts approach? Do you have any insight to this, QM?
Yeah, there's a lot going on in the QM versus non-QM space. The first thing that your listeners need to keep in mind is that the vendors are out there coming up with products, coming up with software and so forth to deal with this to the extent that they know how to deal with it. But lenders shouldn't rely entirely on their vendors to determine whether or not, for example, a loan is QM or non-QM. For example, many vendors don't even receive all the pieces of information that will determine whether a loan fits into the QM box or not. And so to say, you know what, we can just ignore this QM thing, our vendors will take care of us and we don't have to worry about it. You know, we'll put a loan in our pricing system and it'll tell us whether it's QM or not. I think that's a mistake. I think that companies really need to focus on some of the things that are going on out there in terms of QM. The second thing that folks need to keep in mind is that, yes, there will be a non-QM product. I haven't seen it flourish yet. I mean, we're not there yet, but the old Bank of Internet, B of I has come out publicly saying that they will be an investor of non-QM loans. We've got Fenway Summer out headed up by the ex-number 2 guy from the CFPB. And by the way, the CFPB will be the first to admit that just because a loan doesn't fit into that QM box doesn't mean it's necessarily a bad loan. And it's certainly not a subprime loan. A non-QM, listeners should know non-QM doesn't mean subprime. So in terms of investors, B of I and then this Fenway Summer, and I'm sure more will come up. So then the question is, sitting here looking at it on my screen, what about the correspondent guys? What about the Wells and Citi and Chases and U.S. banks and so forth? Frankly, I think that they will offer this type of product, certainly at the retail level. At this point, I have heard nobody publicly state that they will offer non-QM products to correspondent or to their broker clients. So, say what you will about the big banks. At this point, I haven't heard anybody say they're going to offer it to customers. I've heard talk about offering it at the branch level. Certainly banks, large and small, are moving towards non-QM products. They would view these loans as portfolio products that they might offer to their wealth management clients or their depositors as a way of keeping that business in-house. And everybody on the phone will tell you that if they would lend at let's say a 50% loan-to-value loan to 2 doctors who are making $300,000 a year each, and $1 million house, and but the DTI is, gosh darn, that DTI is whatever it is, and it's a non-agency loan or whatever little court puts it into the non-QM box, they're going to make that loan all day long, and they certainly don't want to give that loan up at the retail level for a bank. So I do see non-QM lenders, non-QM investors. I think we'll see an increase in those. And then the question is, at what kind of price? What kind of rate and price? In the old days, we did have subprime loans and the AIMs and beneficials, household finances, and so forth. They knew where to price that product. There was a risk associated with it, and they knew where to price it to get it. And that margin between A paper and subprime slowly disintegrated as Alt-A entered and alternative documentation and so forth entered into it. So that margin shrank. Will non-QM loans be 8, 9, 10%? I don't think so. I think the market is too efficient for that, and I think many of those loans are too good to charge those borrowers that high of a rate. So
Got it.
Either that, either the non-QM investors will proliferate, or the CFPB will say, wow, maybe the National Association of Realtors and all the special interest groups, the first-time home buyers and so forth really are right, and this definition is too narrow for the industry. And we have an unintended consequence yet again, so we're going to change the QM definition, but that's not happening yet.
Got it. So let's do one. I mean, we were getting question after question, so let's do one more, and then we'll do the Q&A. So what's your view, and we got to make this a short one, because we've got about 20 minutes left, so that's not bad. What's your view on the emergence of the non-agency products and investors? You kind of touched on this a little bit already, but given the uncertainty with Fannie Mae and Freddie Mac, it seems like there's a lot of activity, but not much volume or securitization.
Yeah, we are. I hear everywhere people talking about, gosh darn that Wells Fargo, gosh darn those retail jumbo rates. In jumbo markets, they're beating us up. They're better than those retail jumbo rates are better than our conforming rates. And Chase is right in there, for example, at the branch level for retail jumbo. So people may have to get used to that to some extent. When you look at the G fees that we're at now, the push towards the money entering the mortgage business from the private sector, for example, away from Fannie Mae and Freddie Mac, more towards jumbo/non-agency loans. We're seeing that now, and we'll probably continue to see that. And so I think that that's just a sign of the times. And if Fannie Mae and Freddie Mac continue to raise the G fee or lower the maximum loan amounts, which they very well may happen by summer 2014, we'll see more of the non-agency loans coming into the marketplace. So, I'm hopeful. I know the folks at Redwood Trust are churning out securities. Other non-agency/jumbo securities have happened, but not to the extent possible. So then the question is the market really bad? The market's not necessarily that bad, especially on the jumbo side. On the jumbo side, jumbo loans usually account for less than 5% of the total volume anyway. But if you're a bank and you have a choice of putting that loan in your portfolio or selling it to Redwood Trust or selling it on a whole loan deal, you have those three very basic options. And if you've got a 30-year fix, the odds are you probably don't want it in your portfolio. So then the question is, do I sell it to a company like Redwood Trust or Nomura or Barclays, or do I sell it on a whole loan basis to a to a non-agency loan investor, like an insurance company or a pension fund or an investment bank? Companies are doing both. So many of those loans just aren't being securitized, either because they're going in the portfolio or because they're being sold on a whole loan basis. They're good loans. Many of them are low loan-to-value loans, oftentimes cream puff loans, and there's no reason to securitize them. So you have to watch that jumbo securitization market and take it with a grain of salt, knowing what's going on behind the scenes. It's not as bad as it is. But yeah, I definitely see an increase in non-agency, and it's not necessarily because Fannie Mae and Freddie Mac are going away by by Memorial Day next year. They aren't going to go away. They're going to be with us for a number of years in one form or another. And so that being said, I think private money will come into the market, and we'll continue to see more more non-agency loans being originated.
Gotcha. And one of the things that that we talk about is, and that's just kind of before, the thing. I mean, before we started was, you travel a lot and you go out and see all these places and travel the country and do all these different things. And what are you hearing? What are you seeing? What's the word on the street? I mean, everyone knows, the published stuff is not as much as the word on the street. What's the word on the street? What are you hearing?
The word on the street is that well, let me think about this. I would say that right now, companies and loan officers are conflicted because they've gotten in the business to help people and to help home buyers and so forth, and so they're there to loan money. They're there to try to focus on keeping borrowers happy and so forth. Now their head is turned. Their head is turned towards compliance and regulatory matters that many of the older folks in the business they don't really want to do, and so they're having a tough time dealing with this new compliance atmosphere. And so really, is it helping the borrower? Probably not. So that's what I'm seeing out there. I'm seeing old-time lenders saying we're here to make loans, we're here to help the borrowers, and so how are we going to do that? Do we really want to focus on compliance? Now at conferences and so forth, you don't hear people talking about going out and getting new business and new sales techniques and new ways to manage their client database. It's all compliance and QM and non-QM and ECOA and LO comp and so forth, and that's where the industry is right now, unfortunately. So
gotcha.
I don't know if that benefits the borrower or not, but that's where I'm seeing out there.
Gotcha. Now this is a question. Can you cover if the title policy counts in the 3% fee cap, if it's an affiliate of the lender, and if the seller is paying for it? Also, does the home insurance policy first-year premium count to the 3% if it's an affiliate of the lender? And then also the appraisal fee, because we got 3 different questions that are all kind of in the same, a 3-for-1 special. So basically, any affiliate of the lender, does that include it in the 3%?
I think at this point the industry is thinking that it does.
It does.
But I'm not. It keeps changing, which is one of the problems with that the industry has with CFPB and so forth. They keep revising some of these rules and some of the things like that. The industry continues to look to the CFPB for guidance on and continues to not see it. And so some of these questions I don't know the answer to, and I don't know if anybody knows the answer to yet.
Gotcha. And that's something, and I guess this is generally speaking, and here's maybe, you've seen the disassemblance of some of the joint ventures. You've seen, Rel's valuation sell off their title company and disassemble that joint venture with Wells Fargo. You've seen, I've seen CoreLogic and run down, and disassemble their appraisal company and First American, and and the theme of things, and maybe you can agree or disagree, or the theme of things is they want you to make money off of what your core business process is, whether you're a lender or an appraisal company or a bank or anything. And is that pretty much the same thing you're seeing? Meaning,
yeah. Once again, you have the question is the borrower better off? Is the CFPB is there to protect the consumer. It's in their name, the Consumer Finance Protection Bureau. So what are they going to do to protect the consumer? Well, one of the things they're going to try to do, or one of the things obviously they've looked at, is steering of borrowers towards certain products, towards certain services, because one entity owns the realtor and owns the builder and owns the mortgage company and owns the title company. So is the borrower being taken advantage of because of that? And many people in the industry feel that the baby is kind of being thrown out with the bathwater here in terms of gee, if we've got to dissolve all these affiliated relationships, is the borrower really better off, or does it cause more problems than it solves? But the trend right now is definitely toward dissolving, or certainly keeping at arm's length, many of these affiliate relationships. I don't know. What are you seeing on the appraisal side, on the AMC side? Obviously, a lot of companies own AMCs, right?
Well, yeah. So you're right, and the thing is I've never, number one, I haven't really seen it done right, and number two, I've never seen it as a long-term play. I mean, a lot of times we see lenders that start their own deal because they want more control, they want to satisfy the field, they want to, their loan officers, or branch managers, have this anti-AMC perspective, and so they start their own thinking they'll, and they end up with kind of a, it's kind of like the old LOS system that, and lenders would make their own LOS system and think it's the greatest thing ever, and you end up kind of with a piece of junk that you can use barely. And the same thing happened on the appraisal piece. Is they don't make as much money as they thought they would, if they do at all, and then you're dealing with a ton of other stuff. And I just don't think, from what I've seen and what our clients have thought, I just don't think they want you doing any other thing but your core process. So if you're going to be a lender, be a lender. If you're going to be an appraisal company, be an appraisal company. It seems to me that the spirit of things, and and if you look at some of the things like all the disassemblance of these huge joint ventures at the top, but specifically with Wells Fargo and some of the other larger companies, you can kind of see, you can kind of see where things are going long term, and it's probably going to be that, if you're going to do this, if you're going to be a lender, you make money off the loans. If you're going to be an appraisal company, you make money off appraisals. And not try to keep it, because they want to keep things as separate as possible. And specifically the appraisal piece, I know a lot of the, my brother owns a title company in, CLA Title, and he, a lot of the marketing agreements, a lot of the other stuff they have in place with their realtors, you're seeing, some questioning of the validity of those and what they're going to do long term, and are thinking about other arrangements. So I would just say, like, my general, kind of pulling it all into one, in 5 years from now, the idea of a lender owning a title company or appraisal company, and they'll look back and be like, I can't believe we used to actually do that. Okay, the next question. Realtors and consumers and mortgage. Okay, are mortgage disclosures, GFE, TIL, etc., delivered via email sufficient, or they need to wait for an electronic confirmation for the borrower that the borrower will accept email disclosures? Maybe too much of a specific question, but
I don't know the answer to that.
Okay, all right. That's fine. Do you think there will ever be a workaround for borrower paid comp and the interpretation of it being dual compensation?
I think there will be, but I haven't seen anything like it yet. There are a lot of smart people, very innovative people in the industry. I think that if you put a compensation plan out there that is defensible, that doesn't give the appearance of taking advantage of the borrower, because all this springs from, once again, anti-steering, making sure that the consumer is not being taken advantage of. And so if there is a compensation program, if the borrower is not being taken advantage of, or doesn't appear to be taken advantage of, I think that has wings, because it's the CFPB will say, well, we don't, we're not here to make sure that loan officers don't make a lot of money. They've obviously never said that. They just don't want the borrower to be taken advantage of. And so as compensation plans come up, I think that'll be the ultimate test is what is the impact on borrowers out there. So I think that it will. I haven't seen anything yet.
All right, and then this is going to be our last question, but what are the odds of Congress can convince Cordray to extend implementation date of ATR and QM?
In my opinion, less than 10%.
Less than 10%.
I would say, though, that obviously a lot of I know that congressmen and senators have written to CFPB. I know that housing organizations, lender organizations have written to CFPB saying to postpone it. That being said, I would say more people in the industry would just rather have better clarity on the rules. There are so many internal policies and procedures that are gearing up for that January 10th deadline that to say, oh, we're going to postpone it for 2 months, really, I don't think is going to have wings. I know that Cordray has come out and publicly said we're not going to extend it, and that if we look back and the lender was making their best effort to try to comply with the regulations, but just didn't have quite all the ducks lined up on January 10th, then we'll be lenient. The problem, of course, is that a plaintiff's attorney is not going to be so lenient if 3 years from now a borrower goes into foreclosure and they thought they had a QM loan and turned out to not be a QM loan and was originated on January 15th. That attorney is going to go after that.
Got it. All right. Well, that's it, guys. We thank you so much. We really appreciate everyone. I hope you guys had value. This is being recorded, so, for those who, didn't be able to get all the notes, and get everything from Rob. If you have any other questions, here's my email, and I'll, there are so many questions that came in. I obviously, I don't know if Rob's going to do something to answer some of these, but there's so many. I'll try to get them together and send them over to him and see if he has time to do it. But thank you so much. And from here, people at Coester VMS, just a little bit about us. We're a national appraisal company and do appraisals in all 50 states. We won the October Research Innovation Award for most innovative technology in the industry, and we have probably one of the better AMCs in the country. I'm a licensed certified appraiser, and our senior vice president is a DE underwriter and has a lot of experience in the mortgage industry. So we have a great combination of both. Recently released a artificial intelligence-based appraisal review technology that is just out of this world, and you can find information on that on our website. So thank you so much. Rob, anything in closing?
No, keep helping borrowers.
Yeah, absolutely. So guys, thank you so much, and everyone have a great Wednesday. Bye-bye.
Thank you, Brian.